It's not as easy as managing a residential, and it's really dark waters if you don't know how to manage a commercial asset properly.
What the heck is going on with incentives, and how do they get so large, and how do institutions pump valuations up?
You could probably do it yourself, but you're going to stuff it up.
Best value add strategy you've seen your owners implement?
Pre-committed Woolies to take the whole thing, and then as part of that, they stripped it out and built what is now Dan Murphy's. So that was turning $3.25 million into 22. They said to me the other day, we've got 300 we want to spend in Sydney, 300 mil, and we don't need to go to the bank. And you're like, wow.
Hi, g'day, how you going? Phil Tarrant, co-host of Inside Commercial Property, and welcome to episode 57 of our podcast, which we've been at now for nearly 5 years. We kicked it off during COVID to give some sense for the madness that was happening back then, and the madness today is just as alive and well. It's very different. Scott O'Neill, my co-host, how you going?
Yeah, good, mate. Crazy start of the year, 2025. It's I think it's going to be one of those years, bit of a roaring 20s vibe at the moment, where there's a lot of people coming out of the woodwork to consider commercial for the first time. So I'm enjoying it, but there's a lot of education that needs to go along with that, because you could imagine all these newbies coming into it. It is a riskier asset class, higher returns for a reason. But I think this podcast is very important to keep a balanced point of view and make sure we're telling them the truth on the ground.
Is there going to be an interest rate cut in a couple of weeks' time?
Oh, well, look, the market's pricing it in, but last time I predicted rate cuts, or everyone for that matter, it's a fool's game, but it's looking likely. I always say I actually hope it doesn't for my personal portfolio. Of course, it's going to make the spreadsheets look a lot better, but as a professional helping people buy properties, I'd like to have a little bit more opportunity to get a good deal while we can, because I believe once those rate cuts happen, it's the competition's going to, it could double, could triple, I don't know, but there's a trend of a lot of more people waiting for that, and that will probably bring some opportunity, more stock, because I want to sell some resis, and the first thing I think about is I'm not going to sell until the rate cut happens. So I will not release the supply until the interest rates say it's a good time, and I'm sure there's thousands of investors thinking the same thing.
We've been getting a fair bit of feedback, and thanks everyone for their feedback. And some of the feedback, Scott, that's been coming through has been around, hey, you guys are really good at talking about buying property and what to buy and where to buy and how to buy. We don't cover enough what it means to hold the property, to manage the property, and how you can go about not only creating value in your property investment portfolio through better management, but also some of the stuff you need to be aware of. So we're going to drill down into that today, and I do it a lot personally on a lot of the resi stuff I talk about. It's always about the buying rather than the managing. The managing is not that sexy, and
the buying's the fun part, isn't it?
The buying's the fun part, and typically, I think about the administration of my property portfolio. I get quite fatigued with it, so it's probably why I don't talk about it a lot. But if you do this bit really well, you're certainly going to get a different outcome, no doubt, at the end of the day on your P&L. So we've brought in a special guest into the studio, Daniel O'Brien, CEO of X Commercial. Now, Daniel's he's been at this for a little while, a couple of decades in commercial real estate. Prior to X Commercial, CBRE, Knight Franks, all the big who's who, and you've gone out and done your own thing. Welcome to the show, Daniel.
Thank you for inviting me on.
X Commercial. You haven't had any legal letters from our good friend Elon over?
Not yet. No, we had first mover advantage, so I thought of X Commercial before he did. So
you're a commercial property guy.
Yeah.
How'd you end up in this game?
Well, I used to sell residential, and then thought, I want to sell something bigger. So started at CBRE 20 years ago this year, and had 10 years there, and 2 years at Knight Frank, and then I wanted to build something for myself, and I did that with a commercial franchise 8 years ago, and then had that for 5 years, and then started X 3.5 years ago.
I guess you can measure the size of a real estate company by the size of its rent roll. So Sydney-based, Metro Sydney-based. How
Sydney,
wide do you go?
At the moment, we've got a franchise office we opened up in Melbourne 6 months ago. We're opening up in another country around Easter, and we'll be open in other states across Australia over the next 3 or 4 years.
So national expansion and
franchise. Yeah. So there's been no commercial agency model designed by agents for commercial businesses, because you've got the big guys at the top of the market, CBs, Colliers, all the big guys, and then you've got a lot of independent or little franchise offices in commercial, and I think there's a gap in the market for someone to do what the big guys do, but are owned locally, and we can move a bit faster than the big guys. And yeah, that's our plan.
So much like a resi agency, I guess the value of the business is the rent roll, and
Yep.
and the dollars come through the door through sort of sales, transactions, and commissions.
Correct.
Yeah.
The asset's the rent roll, and that's why we want to talk to more investors and help them manage their assets, because it's not as easy as managing a residential house or apartment. There's a lot of different variables that go into commercial, and some investors have been doing this for a long time and are very good at it, and some, are getting into it, and it's really dark waters if you don't know how to manage a commercial asset properly.
Commercial property is intrinsically connected with the Australian economy. You must be pretty dialed in on what's going on.
Yeah, well,
how that's influencing business.
Hopefully, yeah.
You'd like to think so. We're going to ask you about it today. So
Look, investors have been waiting the last 3 years. There have been investors trading, but most of them have been just waiting.
Yeah.
And everyone's been scared. The Reserve Bank did a great job of scaring everyone, and they did. But since I've come back this year, there's been a great sense of, okay, we think we know what things are happening now. Certainty with investors is all they want, and they're getting that now. So, yields have floated around, but they're landing now at a point that's fair for the owner and the buyer. So I think this year and next year, like Scott said earlier, will be a year of trading.
There's been a shift within the investment community over the last period of time, and maybe some of it's got to do with the fact that we do this podcast. We talk a lot more about it, where you have a lot more resi investors are now considering commercial. Are you seeing that? Is there a greater aptitude or attitude towards commercial property from investors now that typically who are buying the chicken shops, for example?
Yeah, I think so, and it's because of guys like Scott, buyers agents who are telling them, hey, listen, forget your 2 or 3% yields in resi, you triple that in commercial. Yes, there are things you need to look for and be careful of, but when you've got a great advisor, they can handle that for you. And similarly with an asset manager, you shouldn't be doing this yourself. Like, you could, but your times are more valuable, right? Whatever your business is, you've obviously got a few $1 million to put in a property. Don't manage it, because you need professionals to do it for you. And it's all tax deductible. And if you miss one thing, like I had a client, he had 10 shops in a row. He leased the one in the middle on a 2x2x2x2x2 lease. And a developer came and gave him a big bag of money, and he couldn't sell it because he said, he's only got a 2-year lease. And I said, mate, he doesn't. He's got 12. He's got a 12-year lease there. 6 2-year options. That's 12, mate. You're stuffed.
Yeah. So just undervalued the asset.
Oh, completely. And the offer was 12 mil. And it was nearly, I said, mate, sorry, it's nearly worthless. Right? Unless you chop each shop up and sell them all.
Yeah.
And that's a 2-year process, right? And even then you'll get 60% of what you've just offered.
It's a good story. And I want to sort of try and get some of that colour into the chat today rather than talking theoretically. I'd like to talk about examples. But Scott, any sort of objective from you particularly for getting Daniel? I don't think you guys do. But have you bought anything off Daniel, or you
not yet?
Have we?
Stuff? No,
we've come close a few times, but typical Sydney agent, they like the sharp yields, and we're always trying to get north of 6. But
is he out wine and dining you, take you to those fancy restaurants that you see
but we
commercial
do,
agents everywhere?
Yeah, it's on the cards. But the numbers need to stack. So, but now look, I wanted to get Daniel on for a few reasons. One, he's extremely experienced. You're very good at articulating things, basically in easy to understand methods. And one thing I just wanted to take a backward step is, because you mentioned asset manager. So I thought, why not just go back to the basics, explain to the listeners what's the difference between leasing, asset management, all of those little parts of it, because they all do play different roles, particularly in the larger deals, and how you manage it as a business.
Yeah, okay. So generally there's 3 or 4 pillars to an agency. One is sales, then leasing, and then asset management, and then valuations. And then you can even get facilities management, which is for big office towers. So they're the 4 or 5 pillars that any.
And can you explain rough the fees? Like, obviously because this is one thing a lot of people years down the track, they get a new 5-year lease and go, there's a big fee in there.
Yeah. Okay. Right.
So how would you sort of
Okay.
explain that when
Yeah.
you deal with your average client?
Yeah. So you've got lease. So if you have a tenant or property that becomes vacant, you're up for leasing fees. And those leasing fees could be anything from 12% to 18% of the entire rent collected over the term of the lease. So the fees are big.
One way I always explain to my clients is, in resi, you got, was it 1 or 2 week letting fees? And you might be doing that annually. If you're signing a 5-year lease up, 5 times 1.5 rent, like all of a sudden that fee sounds pretty fair as a percentage. It's reflective of resi. It's just in bulk. That's really the difference.
That's right. So instead of paying a leasing fee every year, you wait 5 years and you pay a little bit bigger one.
And then obviously you're going to be collecting potentially cash bonds. You're also going to add value. Like the minute that 5-year lease is signed up, your property could be worth 10% more.
That's right. And a good agent would look at things like annual increases and make good clauses and things that you can maximize a lessor's return that aren't that obvious. So if I get 10 grand a year more on a lease, well, over 5 years, that's obviously 50 grand. But if I get a 3.5% increase that an owner's agreed to, and I get a 5% increase, it sounds like a little bit, but it's actually over 5 or 10 years compounded. That's actually a lot of extra money for the owner.
Yeah.
And if you have a good leasing agent, they pay attention to those things. And I've seen make good clauses trip up so many owners. Tenant will walk in and go, I don't want to pay. I don't want to do a make good.
Yeah. What's one of your worst stories on that? Like an actual example of a make good issue that you've run into in recent times?
Well, there was a car showroom building that I sold about 5 years ago, and it was built specifically for this car automotive facility. Because it was built and there was a deal done and a turnkey, so the company went in there, they said no make good. So they had all these hoists and even diesel things in the ground, and there was no make good. Now, the person who came into that deal and bought it, after the 10-year lease was signed, an investor came in, bought it thinking, great, I've got Volvo or whoever the company was, I've got him here for 10 or 15 years. But after that, he didn't realize that the floor was the ground was contaminated because the petrol tank's in the ground. No make good. No make good from the tenant. So the tenant just gave back the keys and left. And the investor coming into it didn't realize there was no make good in the lease. And if they had someone who knew what they were doing, they would have said, well, you're up for all these costs. Just so you know, before you buy this thing, in 10 or 15 years' time, you're up for all these different costs.
Would you blame the lawyer at all for that one as well?
Yeah, I would.
Yeah.
Definitely.
You guys have to slow down a little bit for me because you guys are in around this every day, but I'm probably more reflective of our listeners. So you've just covered about 3 or 4 pretty significant management negotiation type of issues. So I just want to pull that apart just a little bit. So to start with, so putting a new lease into your, because invest in commercial property, so getting a new lease set up. So my manager will get between 15 and 80% of the value of that lease as a payment for the purpose of putting that lease together for me. I pay you that money. When do I pay that? Is it front end or is it amortized over the cost?
Just one payment, day one.
It's a big chunk.
Yep.
The total value of the 5 years of rent that comes through, I've got to give to you straight away.
The average annual rental, you get a percentage of that.
So therefore, you're incentivized to ensure I'm getting the most rent possible.
Correct.
Because the higher that is, the more you get paid.
Exactly.
Yeah.
Yep.
Okay. So that's a good thing.
Yeah. And that parking goes into that,
right?
What you charge, if you charge extra for parking, your annual increases go into that. Your, it's on the gross rent. So it's what outgoings I can claw back for you.
Yeah.
It's all that added up.
And you get pushback from owners going, oh, all you do is just
the professional ones you
updated the most recent lease and send it out to them. I've got to pay you 18, 15% on that.
No, the professional ones don't because they understand.
They get it.
Yeah.
Like a self-manager, you just pay a law firm a couple of grand and probably get it sorted out and you save a lot of money, but then you probably end up with issues
things like that. But the lawyers don't manage the assets.
Yeah.
The lawyers draft a lease. That's a $2.5 grand lease that they pump out on template.
Take it off
most
the shelf.
Of the time.
Right? Yeah.
Yep. So not saying lawyers don't have their place. They really do. But managing an asset for someone, there's a lot goes into it.
On that note as well, I was literally in a due diligence meeting with a client this morning and there was 4 leases. It was like a large format retail. They're all gross and they're all about 35% under market. And that's what happened because they were self-managing. So they were doing the cheap thing.
Yep.
The leases were atrocious too. Like they had these weird clauses to do with giving car park access. And even though 2 of the tenants were nowhere near the car park, like, yeah, it was just a total mess. But what not having a professional involved in that meant was they were way under market, and it was a very tenant-friendly setup. So that would have cost them, in this case, probably about 1.2 mil in the val. We're loving it as buyers because we're just licking our lips going, well, look, this is a value add we're going to action in the next 18 months. Client's going to make 7 figures, or because we just need to get a professional to sort it out. And it's going to be 2 things. Like, you've got to have a good lawyer with good, proper net lease. And then you've got to do the hard yards with the negotiations on all 4 tenants to bring them up to the market. But that's what happens.
That's harder, but the practical reality is that you need to do those. That's where the people get involved. And there's going to be a lot of tenants going,
yeah,
no, this isn't how it's been up until this point. Why do you need to change?
Show them the spreadsheets of all your neighbours. That's what we do. You go, well, move. Where are you going to go? Pay the same there, or stay here, save the cost in moving. You might lose one, but the reality is they've had a good ride for a while, so lucky them.
Yeah, you've got to make good with a tenant, and you're like, you've got to strip this whole thing out. It's going to cost you 100 grand.
Yeah.
Or pay me 80 and I'll do it for you.
Mm.
Oh, no worries. There's 80. Great. So the fit out stays in, and the next tenant rolls in and goes, wow, I can use all this. Can you take those 2 decks out of the front? No problem.
Yeah.
And the owner just pockets the 80 and in they go. That happens all the time.
And it's factored in as an incentive. So the person coming in thinks they're getting a good deal because they're getting all these incentives around
Correct.
fit out and expenses. And this is a really thing I'd like to talk about, is this whole idea around fit out. So as an owner, when you get into the merry dance of what you actually contribute in terms of negotiating a lease, what you throw in as part of the incentive towards doing the fit out for the tenant and or them doing it themselves. I always do my own fit outs, right?
Yep.
Because I know
as
people
the
that
tenant?
as the tenant.
Yep.
I never factor it into a commercial lease, because I want all the benefits, the upsides of it. Whereas
you can depreciate that.
Yeah,
you can amortize it down, and but the owner can as well. If the owner owns the fit out, I've seen one owner. Oh, he put the fit out in, and then he assigned it to the tenant for $1. So,
fit out.
So the tenant, so they got all the benefits of him putting the cost in, and he was just a naive guy and managing his own thing. And I was like,
a lawyer wouldn't catch that. I would say the agent should catch that.
The agents catch that.
Because a lawyer's only as good as, I like lawyers, but you've got to instruct lawyers. Right?
You do. Yeah, you do. And it's like, the old I guess analogy of an agent is, you use car salesmen, you can't trust them. Like that, I believe that's gone now. They need to be looked at as, I'd like to think we're looked at as, we can actually add real value to you, right? Like a solicitor or an accountant can. Like, you could do your own tax return, but you probably stuff it up, right? So you go to an accountant. Same thing. You got multi-million-dollar assets sitting here. You could probably do it yourself, but you're going to stuff it up.
One big thing I've always wanted to ask, like, someone like yourself, you do have a lot of office. So incentives, that's another big part of it, probably next part of this discussion.
Yep. What
the heck is going on with incentives, and how do they get so large, and how do institutions actually build them into their net returns and obviously pump valuations up? Like, I've always thought, isn't an unethical thing, but someone on the inside, do you see it that way as well? Like, because you're the orchestrator, you kind of help these things happen.
He's asking for all these secrets.
I've always wondered, like, because the incentives can be up to 45%, so it's
absolutely,
it's fake money.
Well, I'm doing a deal in the city now, 35% incentive on the net rent.
So explain to the listeners, just dumb it down, what an incentive means.
Let's say 33% incentive. So it's a third of the rent can either be across the whole term of the 5 years, for example. You add that up, and whatever that amount is, the owner will give that to the tenant to either help them with their fit out, we'll give them a rent-free period, or we'll just discount that rent by a percentage across the term of the lease. So I don't know how they started, right? It was before I got into the game, and I've wrestled with it as well. It's just a standard thing. And owners do it to protect their valuation. But again, I don't understand, because why don't the banks take that into account? This is all above my pay grade, right? It's just a standard thing. So the face rent is $1,000 a metre minus your incentive. So your effective rent is $666 a metre. And that's what tenants care about. What am I actually paying? I don't care about how the owner wants to cook the books. All I want to know is what I'm paying out each month.
I always think it's a way of predicting where the market's going too, from a growth point of view. Because even those big reports that, the Knight Franks or Colliers or whatever spit out every quarter, they show the average incentives. So like, Sydney might be like North Sydney where you're at.
Yeah.
It's probably one of the highest in the country.
40%.
And then like industrial, which is a tighter, is into the teens. And obviously every market's different. But, the way to look at it, like if you've got to incentivize the tenant more to sign a longer lease, then it must be a weak market. But there is a baseline which, like to your point, kind of crept in over time, which became standard. And maybe that's like because fund managers use it to keep valuations up. I don't know. This is where it gets cloudy for me because at our level,
it's all above our pay grades,
Yeah,
right?
I think so.
And in the sub $10 million range, it's kind of not as prominent as like the bigger it gets. It creeps in more and more, doesn't it?
Yep. And we've got private clients who are like, don't worry about incentive, just drop the rent.
Yeah.
I don't need to cook the books. They're like, well, just tell me what I get every month.
Yeah.
And they're a lot of, private, they're sophisticated, but they're like, no, I'm not going to sell this for 20 years. So I don't need to pump the rents to get the val.
Yeah. Well, they're not relying on annual vows unless it's in their super or something
Correct.
like that. So
Yep.
who really cares what it's valued?
So what about maintenance? And, they're talking a bit practical as well. And it's obviously a question for both Daniel and Scott. Proactive maintenance is pretty important, I would imagine, from a lease management side of things. From your side, do you get a lot of pushback from owners going, nah, it's all right, air conditioner will last another 10 years, or, don't worry about the awning, it's a bit rusty, but she'll be right.
Generally, if things are of a capital nature, owners pay. If it's a maintenance thing, tenants pay.
Yeah.
That's the general rule.
And when it comes to capital, I always sort of try to time it around when a lease renewal's coming up. Because if you fix an awning or, pave the backyard, to create hard standard, it can be a form of an incentive, in fact. Obviously, It increases the value of your property, but yeah, you just got to be smart when you spend money on your property because it will affect the return. It may increase the value of your property, but keeping tenants happy is extremely important because continuous rental income is how you boost your internal rate of return on your assets.
And value-add strategies, what have you seen that works really well? Like smart, best bang for your buck value-add strategies. And I think, Scott, we're going to have to turn this into a two-part discussion because we're only just gleaming.
A lot here.
It's a lot here. So I think we should break this up because I don't want to just cover over some of these things. But what works? What have you seen works really well? What do the smart operators do, value adds?
Well, you just got to look at the funds, right? What does Goodman and Dexus do when they want to add value to a site? They generally, it's like cosmetic initially. And I've seen a lot of owners get in there and soften up foyers, put, timber or paintings or different lighting. That's kind of easy, quick stuff they could do.
It's all tax deduction.
Yeah, it is. And it adds value, Things like end of trip facilities, they're huge, right? Every building or every refurb now has got, male, female change rooms, bike racks, some gyms. So that's been a real trend in the last probably 5 to 10 years. I think end of trip.
We'll go through a few different assets. What would be your number one tip for adding a value to a middle-age freehold industrial property? Where would you spend money on if you were basically the rents at market? Where's your sort of easy wins?
Things like your access in and out of the site.
Okay.
Right. If that's not smooth and easy for the truck movements.
Yep.
Roller doors. How old are they?
Mm-hmm.
When do the motors need changing? LED lights. You can get solar now rebates if you put those special LED lights in you nearly get them for free, right? If you put them in. They'd be the real easy wins I would do for industrial.
What about, say, you got a small shopping center? I know you manage a lot of these because you can go any direction with those things.
Yeah.
Where's your easy wins with
shopping centers? Easy wins are the amenities.
Yeah.
Right. And also the
Dunnies and stuff.
Yeah. And then I know it sounds weird, and then the common areas.
Okay.
Yeah. And then putting little kiosks outside if you can, depending on how big they are.
Yeah.
Like put in different kiosks or ATM machines are really good.
Yeah.
What we've seen though is in Sydney, like in Botany or places that aren't near a train line, owners of those assets will put on a minibus and they'll charge that as part of the outgoings to the tenants to have like a bus that cycles from, say, Botany to Central and back, delivering people to the train stations.
Oh, sure.
as well.
Okay.
So giving them more amenity and more access to their, making public
So it
transport
makes it a
easier.
more attractive asset because people aren't complaining about.
They're not complaining about distance of transport.
Yeah.
And they say, well, we'll
Because
throw a
parking's
shuttle bus on.
terrible in those areas, isn't
And
it?
it's only getting worse.
Yeah.
So I think that will be a trend that will continue a
So
little bit more.
company-owned transport.
Yeah, company-owned shuttle bus that will just bus
Imagine
them.
that'd be an insurance nightmare, wouldn't it? Like, so the owner would be putting on, say you've got a 20,
I'm talking about
30,
big
like, yeah,
industrial
the big
parks.
industrial.
Like we
Yeah.
picked up a management in Marrickville and there's 200 tenancies from one owner. Like it's 8 hectares of land.
Wow.
So something like that, if they wanted to do that, that would work.
So you spoke about sort of kiosks in sort of suburban shopping malls. What about sort of office, real practical stuff? So end of trip facilities is the key.
I think that, that helps tenants. And then, the carpet tiles rather than carpet like broadloom, that's an easy, not many investors think of that. They, carpet tiles, because you get certain wear and tear around a thing, just pop a tile out and stick a new one in.
How you finding the make good sector at the moment? Is that, like building inside, in and around sort of resi is quite tough. Make good companies, fit out companies or commercial interior companies here.
Yeah.
How's that sector going? Are they vibrant?
There seems to be a lot less of them than there were. So I don't know if COVID's shaken them out, but I used to get calls, 3 or 4 calls weekly from fit out companies trying to come and see me to refer work. And I don't get those calls anymore, thankfully.
That'd be just due to the general weakness in office, isn't it?
So.
It's more of there's a vacuum there at the moment, but
yeah,
it looks like it's improving. The market's starting to come back slowly. Because I was talking to you before, we don't do much in Sydney, but we're seeing a lot more owner-occupier briefs creep in just because people think it's now a good time to buy. Like we're probably, down 20, 30% from peak.
Yep.
Historically, that's about as far as it goes, if you look back at the last few recessions. So maybe it's time to look at it. Like I personally bought an office for Rethink just because I didn't want to rent and spend all that money on a fit out like you mentioned, because if you spend that type of money on fit out, then you've got to leave, it's just dead money. What's
been the sort of number one value add strategy you've ever done, Scott? Would you say maybe a bit left of field?
Oh, left of field. Well, there's 2. They're currently underway. So one that's not left of field. I bought a shopping centre in Queensland, and then next door there was 3,000 square metres of vacant land. So I bought that cheap because no one else wanted it. Then put a DA on it. This is just before prices went up. And then, basically 50% later, thank God I didn't start because it's just not viable to start. So I got a DA for 1,000 square metres of net lettable area. I'm just waiting for it to stack up because based on the current rents that regional market can achieve, you really want to hit probably a 10% return.
For more shopping space, would you put some other sort of asset?
Large format.
Format.
I'd probably do
Freedom Furniture or
3 shops total of, say, 333 square metre type places on average.
Okay.
But it just doesn't stack in that market. It'll creep in, but we need build costs to settle, prices to go up, or more importantly, rents to go up, and then we're in the game.
Would you do that yourself? Would you flog it?
I'd do it just because it's a project, why not? Something to do, and it would actually boost the overall value disproportionately with the whole centre, because the larger the centre gets, the more critical mass there's there. You open yourself up to more of the
But can you get
buyers.
utility of that spare land now? Like you turn in the parking or somewhere or other? Or...
I literally lease it out to a food truck, so for very little. But it's it's just land, so it's just terrible ROI on that one. But it's a long term play. But the big one I'm doing at the moment is like you mentioned, the common area. I bought this shopping centre in Perth, and it had this massive 1980s style arcade in there. Like literally, it had plants that were half dead, and there's looked like kids were loitering in there, dumping crap everywhere. The bins were half knocked over, just terrible look. And we're just going to basically gut the whole thing out. It's about 700 square meters, this thing, and we're going to bring all the shop front doors to the street. So then basically there's no arcade.
Yep.
You're going to sort of make all the entrances street level. So it creates 700 square meters of land. So if you rent that out at $300 a square meter in that area.
So extend what's there currently, or you'll create new sort of spaces?
Well, the same roof. It's just basically, I'll probably have to drop $1 million at least on it, but it'll create $3 million in value. So $2 million upside on that one. The trick is negotiating the leases up front, which
Pre-committing them in.
Yeah,
Yep.
that's your game. So,
Yep.
and yeah, I guess on that note, because pre-commitment, that's something most developers try to do these days, don't they?
Yeah.
How do you do much of that in the space? Like,
Yep.
how do you even go about it? Because the banks will lend on a pre-commitment,
Yep.
which is gold in my opinion.
Yeah. I've put Woolies into the Dan Murphy's at Coogee. That was a pre-commitment before it used to be a rugby club.
Yeah.
Right. So sold that, pre-committed Woolies to take the whole thing. And then as part of that, they stripped it out and built what is now Dan Murphy's.
What do? They pay a deposit, sign a 10-year
AFL,
lease?
yeah, they signed an agreement for lease.
Yep.
It was a 20-year lease actually. But they sign an agreement for lease. They pay a 2 or 3 months deposit. They pay their bank guarantee.
Yep.
And the agreement for lease is what is in place between that point in time and when the building is finished.
Okay.
So when they start trading. So that just ties it in, and then the lease starts, and then away they go.
Well, on the value add strategy, because one of the main reasons I want to get you, and you've got some great war stories over the years. Like, what are some of the best value add strategies you've seen your owners implement over the years? Like maybe top two. I don't know.
That was the best. That was the best one.
Yeah.
They paid $3.25 million for this site in Coogee.
So
And
some investor bought the site
he
from
bought
the
the
rugby
old
club.
He bought the old rugby club.
Yeah.
Randwick Rugby Club. We
Yeah,
had
I
a
know
full expression of interest. I've had so many people come back to me and go, "Why didn't you tell me about that?" I was like, "Well, it was on market. I was trying to sell it. We sold it. The highest offer was 3.25. This is back 10 years ago. Sold it between when I exchanged contracts, and I had Woolies in the background because I knew they wanted to go in there, but Woolies don't buy.
You always probably have Woolies on the background. or
Correct.
something.
We've
Yeah.
got people.
Yeah.
We've always got people in our pocket to
Yeah.
put them into things. So, yeah. So a week later, we did a deal for $1.1 million a year net rental for 20 years to Woolies. So if you look at a yield, even 5%, Coogee,
Yeah.
Sydney, even 5%, that's a $22 million asset. They just paid 3.5 or 3.25.
Did they have to build anything?
No, it was already
Really?
built.
So it's
That was the
literally-
beauty of it. So they just gave Woolies the keys and settlement and said, "You can fit
Wow.
out." And
Like
they
a
did.
family office type investor.
Family
Yeah.
office investor.
Yeah.
So that was turning 3.25 million into 22.
Do deals like this still exist?
Well, no, but
Not
tell you
maybe
what,
the
I'll be buying the next one
numbers
if
are
they do.
different, right? But
Yeah,
like,
that's
how
right.
do you find this stuff, right?
they do exist. It's difficult. Yeah.
Yeah.
It's getting more and more difficult. But that was a receivership sale. Like that was on market. Everyone knew about it. The key was I was the only one who knew that Woolies were looking.
So the key is to find out who's
The
Dan's got in
key-
his back pocket.
Correct. Yeah.
Which tenants. Who's
Yeah.
next.
Let's take him out for lunch, I reckon.
Yeah.
Yeah.
You
Well,
know,
just
let's
ask me.
Yeah.
Bring me a site and I'll tell you if I've got anyone that will suit it.
You just got the live pulse on the market. And that
Yeah.
tells you.
Like I
Yeah,
met
your
an
next
owner
move.
yesterday. We don't manage his assets, but he owns 30 in South Sydney. And I said to him, mate, one of your tenants is moving out next week. And he goes, "No, they're not. They're in here till July." And I said, "All right, well, they were out with one of my guys yesterday. I just wanted you to know." And I said, "Your asset manager should know this because your lease is coming up in 3 months." And he goes, "Yeah, he does. He hasn't said anything." So I'm like, right, well, there's a good example of how an active team who's local can help owners, right? And say, your tenant's actually on the move. They may not have told your property manager, but they're on the move. So, yeah, it's really important just to have, and you need to audit your outgoings as an owner. When's the last time you got the air conditioning contract looked at? When's the last time you objected to your land tax? Because that's a huge issue now. Everyone's screaming about land tax. So we can object on your behalf, right, and get your land tax down in some cases.
On the basis of the valuation that's implied.
Yeah, on the VG just does these desktop vals that are often wrong. And, you know, one guy is paying 600 grand a year in land tax now. And he's like, I mean, it owes him nothing. So he's a multi. So like, it just annoys him.
600 grand, still 600 grand.
Well, we got it. We shaved 200 grand off his land tax bill. And that's not just for this year. That's for the next 3 years.
Yeah. And again, this is the sophistication of it, right? Because you have a valuation of the property at a commercial terms.
Well,
but,
we've got a
you know,
valuer in-house who just looks at their report and goes, "I don't agree with it for these reasons. You should use these comps," and sends it in. And they go, "Okay, yeah, sure, we made a mistake." And that's it. So that's what you get with a professional asset manager.
Do they still exist, these sort of old, sort of third generation, fourth generation families that own most of the commercial property in Sydney? They're still out there.
Yeah.
Yeah.
Yep. They're out there.
making dough. Don't
Oh,
say
yeah.
a lot. Never put their head above the parapet.
No.
It's there.
Yep.
It's still a big part of the sector. It's like
Yep.
rather than sort of
Big time.
Yeah.
Especially in like North Sydney.
Yeah.
North Sydney's owned by a lot of privates. Yeah. South Sydney as well, like anywhere in Sydney. And it's the old family offices who, yeah, you're right, Phil. They don't want any attention and just leave me alone. And
Leave me alone. Still
get
buying
my
the
rent.
cash.
Yeah,
You know,
yeah, yeah.
these are the people you're competing against, right? In many
Yeah, I
ways,
know.
you know, because
a lot of people forget like the percentage of ownership a family office has in commercial property because they want the yield, they want the passive nature of it. And, you know, they don't go buy 200 houses in the burbs. They buy the shopping centre or the tower, and they're going to have a very high percentage, and the rest is in ETFs or private residential properties. But yeah, it's where the big money goes.
it's the quiet wealth that exists in places like Sydney.
It scares you. Like
Yeah.
we've got clients, right? It not scares you. It's inspirational. We've got a Hong Kong family, and they manufacture picture frames, but they're the biggest manufacturer of picture frames in the world. Like they sell to Walmart, and
That's a big company.
that's huge. And I don't know what turnover they would do, but they said to me the other day, we've got 300 we want to spend in Sydney, 300 mil. And we don't care if it's one asset or three assets, but it's got to be at least 100 ticket price, and we're happy to buy 3, and we don't need to go to the bank.
Yeah.
And you're like, wow.
Sure, here you go.
Yeah. It's like,
Here's an office tower in
it's
North
mental.
Sydney.
It sounds like they need a good buyer's agent.
Yeah.
And
don't
you
they?
walk past them in the street, and they just look like a normal Joe. You know?
This is it, right? But you know, and this comes back to the earlier point around. I think you've got this old guard of commercial investors, but this is sort of transition, and I'd put myself into the latter. This transition of people who have been able to create some wealth through resi real estate, who are now this next generation of commercial investors. You know, get fast forward a couple of generations, you've got this sort of nascent nucleus now of these people who are creating it. People like Scott, right? Like, you know, they'll be these people.
Well, it's the whole baby boomer generation. They still own 50% of the world's wealth, and that's getting transferred. So there's going to be, like, the next decade's going to be very interesting, particularly in your world, because I bet many of your owners are quite elderly and maybe don't have the biggest succession plans. Like family offices have the next 3 generations sorted, but yeah, there's going to be a lot of that wealth transfer, and that will result in sales. But you know, it's obviously compounded by all this new wave of buyers out there working out it's actually a good place to invest if you know what you're doing.
That's right. Yeah. And
look,
look, we've talked about a lot of the negatives and the things you need to look out for. It's really not that. Like, don't be scared because if you've done residential, that's just headaches. It's headaches from day one with tenants. This is no headaches. Well, sorry, if you get it right, limited headaches. You get your net rent paid. Any increases in outgoings are paid by the tenant. It's isn't it a lot easier for the investor coming out of resi to go to commercial? So don't be scared by it. And
I don't want to frame this podcast as, you know, commercial property investment is swimming with sharks, right? Because it's not. There's just a different layer of knowledge and sophistication, complexity that you need to be conscious of, and therefore you get it right, there's probably greater reward.
Yeah,
and that's
I
the
think
balance.
The listeners want to hear the warts and all stuff, and you know, we've probably covered about as negatively as you could, but you know, the reality is you hold these things for 5-10 years, it's you're going to do very well. Like, you would have countless owners that would have doubled their money in even 5-6 year periods, you know?
Yeah. Well, in Sydney, if you had industrial in the last 12 months or 2 years, your rents went up 30%.
Yeah.
So your asset lifted 30% and you didn't do a thing.
Exactly. Plus you got the good yield on the way. And that makes the real big difference. We always harp on about like yields in resi are 2 to 3% net, but you can get 6 to 7. Like, you're getting double the return plus similar growth rates, if not better, if you're in industrial.
And that's the misconception, right? And that's what you're doing well, Scott. You're saying, well, the growth rate is similar in commercial to resi. And a lot of people have said, well, I'm buying resi for the capital growth.
It's still out there. I literally saw someone yesterday on a reel just going, oh, commercial, you don't get growth. I'm like, just read a book or look at a result.
Well, listen
Who
to this
told
podcast.
you that? Like,
well, the thing is, I'd rather get 30% uplift on a property in Sydney and 30% uplift in a property in Perth, right? Because, you know, the continuity of that Sydney-based property is probably, you know, and, you know, the way it's factored in is different. You know, it's based on the machinations of the lease and how you can add value to it. Some of this we've spoken about today, but, you know, this whole thing around selling, you know, I think we should just the whole thing on selling, like when to buy, when to hold.
Love to.
When to sell. So we've got to bring you back. But Scott, what we normally do at the end of our podcast is do a couple of questions from our listeners. So while we've got you here, we'll ask a couple of them.
Mm-hmm.
But just There's a question here on supply coming to the market. And let's talk specifically about Sydney. Can you give us a sense for commercial, for like maybe office and industrial supply?
With the construction costs at the moment being so high, supply has been slow the last few years, but we've got 3 projects in Western Sydney, industrial, that are kicking off this year, and they're all 20, 40 and 60 unit strata estates. So these things are costing $2,500 a metre to build. They're selling them for $6,000 or $7,000 a metre. There's margin in that. So I think now, after 2 years of not much development, the next 2 years I think there'll be more stuff on the market.
A lot of that driven by Badgers Creek type stuff.
Yep.
Yeah, look, and you can see national vacancy rates in industrial have probably gone up 20, 30% in the last 6 months. Like, that's off an extremely low base, by the way. And it's because rents have got to a point where margins have crept in. So you can see places like Brisbane, particularly smaller ones, like there's pockets like where there is more supply coming on. They're still getting absorbed, but as an investor, you just got to be quite careful you're not buying too late into the piece, because that could take another year to absorb, and then you might have a longer vacancy. So that's why in that last podcast I was mentioning I'd be careful buying, with all the resi buyers agents coming in, because they're going to play in that entry level vacant space. And if you get it wrong, you might have a vacant property for a year. Who knows? Just because there's a new development with 20 that's popped up next to you, and then you've got to wait for them to get absorbed. And there's a bit more coming on, but it's a very tight market.
And this is sort of connected with another question here. This idea of a property clock, right? Where is Sydney? Is Sydney sort of gearing up? And I know there's a lot of contingencies at the moment for this first half of the year.
Yep.
Interest rates, federal election, etc., which will have some impact on how markets or appetite for commercial markets perform. But are we in a period of build up when things are going to rocket and accelerate?
I reckon, yeah, if you look at the market as midday is the peak and 6 p.m. is the trough, I think we're about 7:30, 8 o'clock. So we're coming around. And I think, this year will be a great year.
So when's too early to start buying? You're going to say straight away.
He's a sales agent.
It's never a bad time. It's never a bad time for a good deal, right?
But there's good deals out there. So what's a good deal look like to you now for a buyer?
Anything in Metro Sydney at 6% with a 5 or 10 year lease, that's a good deal.
Irrespective of asset class, or
Yep.
I liked your analogy because I'm very yield centric, because I'm an investor using little money to create money, basically. So I'm not parking cash up when I started. But you've got a good analogy, like why people accept lower yields, because, and I think, you mentioned it somewhere. It's like you get the growth and it becomes good. Or there was another analogy, I think it was to do with, it's just going to cost you more because you're a Sydney focused, agent. But it made a lot of sense. Like, why do people accept a 4.5% yield when interest rates are 6.5%?
Well, it's because they're paying 50% deposit.
Yep.
Or they're buying with a 50% deposit. So that doesn't really matter. And the fact that they're in a blue chip location in Sydney.
Yep.
Wait 10 years and you're going to double your money. And wait another 10
for the growth.
That's it.
Yeah.
So it's a long game, and just sit in.
It's pretty simple, isn't it, when you break it down?
Like, really? Yeah.
And that just goes back to the growth equation. Like, you're here for the growth. The cash flow, that's the kind of decision to start looking at it. But then you go, well, I'm still going to make more money from growth long term, and it compounds on itself. And then you can buy more cash flow assets. And that's the true trick to this game. You just scale the portfolio larger. You can keep going, especially if you're investing 50% loans, doesn't matter what the interest rate is, really. You just keep going.
And the bank just looks at the lease, as you know.
Yeah.
Like, they're just worried about the lease and the tenant rather than your serviceability.
Yep.
So, buy more commercial.
That's the idea. This is why I like sort of, it's always a nice way for me to reconnect formally with what I'm not doing. And I just sit there thinking about it. It's just time, right? Like, I sometimes sit there thinking I'm wasting time, because the longer you're in the market, if you're buying well, the greater the upsides of growth. So it's always a nice way I'll go back to the office now and just go, sort some stuff out. But mate, thanks for coming in, Daniel. I've really enjoyed it.
No, thanks for asking.
And we'll certainly get you back.
Great.
There's a lot we really want to cover around the practicalities of ownership. But we've gone a little bit in the buying, but there's also the whole thing about selling. But ex-commercial, people can track you down, no worries. Just
go to the website.
Yeah, and then anywhere in Sydney. So if someone's going, I like the sound of this guy. I'm thinking about changing managers.
We've got
a chat.
love to.
Yeah,
love to. just want to help more people. So we've got 5 offices in Sydney at the moment and 1 in Melbourne. And we're just looking to talk to more commercial investors out there. So please reach out.
The whole ownership side of things could be another 50 podcasts. That's the reality. So we want to target a few questions. So if the listeners have any specific questions that, Dan, myself, and others in the industry can help with, like we'll just smash another episode out and get it done. Because again, the reason we had this podcast is most of the listeners now own at least 1 commercial property. That's what, we've done surveys and there's a lot more wanting to buy, and that stat's just going to keep kind of favoring the owner. So we need to cover this topic a lot more. And
they won't stop at 1. Once they get their first one, there'll be more.
Keep going.
Yeah. Well, they normally, as I always say, they sell their resi side down or sell their shares or buy one in super or refinance their house because there's equity in that. Once you see it, it's addictive because it works.
Yeah.
You're giving yourself a pay rise. Every time you buy, it's a pay rise, because it's cash flow positive.
Better go back to the office.
That's
wasted time. But anyway, luckily I know some people in around commercial property helping me with this stuff. But Daniel O'Brien, CEO, Ex-Commercial, thanks for your time today, mate.
Thanks
really
so
good
much.
to see you. And Scott, I know you guys are all systems go. So people can just track you guys down if they want to be on.
Yeah, just Google Rethink and looking forward to another
Sort
busy
it out.
year.
Okay, well, thanks everyone for tuning in or watching us wherever you're dialing in. We'll see you again next time. Until then, bye-bye.